Ladies and gentlemen, good day and welcome to the Kalpataru Projects International Limited Q2 FY24 earnings call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Bhumika Nair. Thank you and over to you, ma'am.
Thanks, Sagar. Good morning, everyone, and a warm welcome to the Kalpataru Project International 2Q FY24 earnings call. We have the management today being represented by Mr. Manish Manot, Managing Director and CEO, Mr. S.K. Tripathi, Deputy Managing Director, Mr. Amit Uplenchwar, Director Group Strategy, and Mr. Ram Patodia, President Finance and CFO. At this point, I'll hand over the call to Mr. Manish Manot for his initial remarks, post which we'll open up the floor for Q&A. Over to you, sir.
Thank you, Bhumika, for hosting this conference call, and good morning, everyone. A very warm welcome for our Q2 financial year 24 earnings call. Let me start with the performance for the quarter. Post that, I will update you on the individual businesses, key focus areas, and outlook for the full year. We have delivered another quarter of resilient performance with improved turnover, sustained profitability, and strong order wins. We have scaled a new milestone by crossing rupees 4,500 crores of quarterly consolidated turnover for the first time. Our order inflows and order book position are at record level during the quarter. We have reported consolidated revenue growth of 19% in Q2 and 17% for the first half of FY24. The revenue growth was led by improved execution and healthy order book in our T&D, B&F, water and urban infra business. Our consolidated EBITDA margin are at healthy levels of 8.2% in Q2 and 8.6% in first half FY24. Our finance cost as a percentage of sales continues to remain stable. Our finance cost as a percentage of sales was at around 3% on consolidated basis, while for standalone it is at 2.2% for Q2. Our consolidated PBT at rupees 132 crores and PAT of 90 crores was reported in Q2. For our first half, our consolidated PBT is rupees 297 crores with PAT of rupees 203 crores. Our consolidated net debt stands at rupees 3,183 crores. Our net debt in our core EPC business, excluding road BOOT assets and Sri Shubham Logistics, stands at around rupees 2,480 crores. Our focus on timely collections and project closures has helped us to maintain net working capital days at around 104 days for the period ended September 2023. We are proactively working and are focusing to bring our net working capital days below 100 by end of March 24. Our tendering activity across most of our businesses remain very strong. We have witnessed robust order inflows of rupees 12,178 crores till date in the current financial year, including the orders worth rupees 1,576 crores declared yesterday. Additionally, we have a L1 position of over rupees 4,200 crores, mainly in T&D, water and urban infra business. We are witnessing increase in tender pipeline in most of the businesses, which makes us fairly confident to achieve our targeted order inflows of over rupees 25,000 crores for the full year 24. Our order book at the end of September 2023 stands at rupees 47,040 crores with a fair mix of T&D, B&F and other civil business. Our international business, which is around 40% of the total order book, is fairly spread across more than 30 countries outside India, which balances risk pertaining to execution and receivables. Now coming to our business segments. Starting first with the T&D business, our revenue growth was strong at 24% in Q2, led by improved execution across various project sites, along with a healthy opening order book. We have secured orders of rupees 5,300 crores till date in the current financial year, and additionally we have a L1 position of around rupees 1,500 crores. On the international subsidiaries front, in Brazil, Fasttel has reported revenue of rupees 192 crores in Q2, a growth of 90% YOY. Fasttel order book stands at rupees 500 crores at the end of September 23. At LMG Sweden, we have achieved revenue of rupees 184 crores in Q2 compared to 256 crores in Q2 last year, with an order book log of rupees 1,427 crores at the end of September 23. Our T&D order book, including our international subsidiaries, stands at rupees 17,000 plus crores as of 30th September 23. Our business environment remains very promising on T&D with strong tender pipeline in domestic and international markets in Africa, Latin America, CIS, and Middle East. Our building and factories business has recorded 14% YOY growth in revenue for Q2 led by healthy execution. We continue to ramp up our execution capabilities to increase mechanization and in-house training and development of labor force. Simultaneously, we are working to strengthen our capabilities in areas like data centers, design-build EPC jobs, industrial and institutional projects. Moreover, we have expanded our market reach by adding new clients in data center projects, residential, industrial and commercial B&F works. We have secured orders worth rupees 4,330 crores in our B&F business and have a closing order book of around 10,000 crores. The delivery time of most of the orders in B&F business is between 2 to 3 years, giving ample visibility for good growth in the B&F business in coming quarter. Next, in our water business, revenue has grown by 55% in Q2 on back of strong order book and improved execution. Our order book stands at rupees 11,423 crores as of September 30th. Our current focus on improving execution and completing the existing projects. Of late, we have witnessed a lot of influx of small and regional players in this business, and now we are working on improving our capabilities on large water scale projects, and also to establish presence in water and sewage treatment projects. In our railways business, revenue has declined by 10% in Q2 on back of lower order book. We have successfully completed trial runs of Indore and Bhopal metro projects within 9 months of the project award for electrification of works. Given the competitive intensity, we continue to remain mindful in our bidding strategy for our railway business. In our oil and gas business, we have achieved revenue of rupees 171 crores in Q2 compared to 220 crores in similar quarter last year. We have seen the domestic tendering in oil and gas business remaining subdued with increased competition. Hence, we are working to expand our reach in processing plants related projects and international expansion to drive sustainable growth for this business. In the urban infra business, we achieved a major milestone by getting favorably placed for our first underground tunneling project for Kanpur Metro. The business achieved revenue growth of 37% in Q2 on back of improved order book and good project progress. We expect our urban infra business to contribute significantly to growth in coming years as we continue to strengthen organization and build development efforts. In our road BOOT projects, revenue per day has improved by 15% YOY to rupees 57.2 lakhs per day in Q2 on back of rise in traffic. We have infused rupees 43 crores in the first half of FY24 in road BOOT projects, primarily to repay the debt level. Speaking about progress made on our key sustainability initiatives, we have formed up our sustainability strategy and have recently announced our sustainability goals, which aims to achieve water neutrality by 2032, circularity by 2035, and carbon neutrality by 2040. We are taking up various initiatives at our manufacturing facilities and construction sites to decarbonize operations and rapid adoption of clean energy. As we evolve and sharpen our focus, we will keep sharing more details on our sustainability outcomes. Before I come to the outlook, I would also like to highlight a few setbacks that we had in the last quarter. First, on the Yuengling project in Australia, we have exited from the arrangement of forming the joint venture. Hence, that project is no longer part of our L1 position. We continue to work for establishing presence in EPC market in Australia. Second, in one of the legacy projects in Brazil, which was secured before our acquisition, we've had an impact of a guarantee encashment of 16 crores, which has been taken to P&L in the current quarter. This has affected the profitability of Fossil in Q2. We believe this is a one-off incident and would not change our strategy of making Fossil break even by the end of the year, excluding this event. Lastly, with respect to sale of Vindhyachal Road asset, the non-binding offer from a potential buyer has not moved forward, and we continue to look out for a new buyer. We remain confident to complete the sale of VEPL in the near future as we are discussing the proposal with other prospective buyers. Notwithstanding this, we remain cautiously optimistic as we move ahead in second half of the year given heightened tender activity, improved execution and strong order book. This should help us improve our performance going forward. However, we remain watchful of increasing competitive intensity, volatile commodity prices, tight labor markets and tough global geopolitical conditions. Overall, we expect a consolidated revenue to grow by 25% plus for the full year 24. At PBT level, we will be in the guided range of 4.5% to 5%, maybe on the lower side of the guided range and not on the higher side. And we're confident to achieve our order book inflows of rupees 25,000 crores for full year. We're working hard to improve our return ratios, especially through divestment of non-core businesses. We remain confident in our ability to achieve progress on sale of road assets, divestment of Sri Shubham, and liquidation of inventory in Indore real estate in the coming few quarters. Of course, as we have said before, market development on such initiatives takes time, and one needs to stay the course for positive outcomes. Having said that, we'll continue to manage our business with agility and pursue growth that is consistent, competitive, and profitable. With this, I conclude my opening remarks. Also, my advance wishes for a happy Diwali to all of you and your dear ones. Bhumika, I would now request you to open the lines for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Parikshit Kandpal from HDFC Security. Please go ahead.
Yes, sir. Hi, good morning. Congratulations on a decent quarter. So my first question is on the international order book. So now it's about 40% of the total order book. So just wanted to understand out of this order book, if you can give a breakup of T&D and non-T&D segments. And pertaining to that, over the next 3-4 years, what is the total addressable market size for us for the non-T&D segment, and how do you look to ramp up the order book in that segment?
Good morning, Parikshit. No, on the international order book, Parikshit, primarily the order book consists of 3 segments today. T&D being the largest, building and factories being the second, and water and airports being the third, right? Water, airports, and roads. So if you look at it from an international order book perspective, our international order book today is approximately 40%, which comes to a number of around 18,000 crores. Out of which TLI, which is the international, is around 11,656 crores, and LMG and Fustel is around 2,000 crores. So out of the 18,000 crores, around 13,700 crores is transmission, and balance would be the civil businesses, which includes B&F, road, water, and airport. As per our strategy for international business, I've said that in the past also, we continue to remain very bullish on this business across various segments. Middle East, we are seeing has a lot of opportunities with the oil levels and the capex expansion there. At Africa levels, we see funding institutes coming back. Majority of them come back after COVID, and we see a lot of projects coming up there also. We continue to remain very strong on the Latin American market beyond Brazil. It's not only Brazil, but even all the other Latin American markets. And with Fustel and Linje Montage, we continue to look at European markets from a Linje Montage perspective and Brazil from a Fustel perspective. Even on the civil businesses, we're seeing a lot of opportunities coming in building and factories in the neighboring countries, and also road projects in Africa. So overall, I think we remain very bullish on the international order book, but I would also say that, we are cautiously optimistic on it, because currently the geopolitical situation is such that we need to make sure that from a concentration risk perspective, from a country risk perspective, we balance everything. And that's also our focus.
But sir, if we have to get some numbers, so within the first half, if you can give some numbers on how much you would have bidded in T&D and non-T&D in international market?
I think the first half, whatever we have got on international is all T&D. I don't think we have got anything non-T&D. We got a small special one, $30 million. Otherwise, everything in the first half, if you look at it, so is only transmission. So there's nothing on non-transmission in the first 6 months of our current year.
Because my only thing is that the entire rationale of GMC and KPTL merger was that we take this segment international, and we're still at 4,000 crores of order book in the international market, non-T&D. So over the next 5 years, 3 to 4 years or 5 years, so how can this multiply significantly from here on, like 4 to 5x, and contribute meaningfully to our overall order book?
So, Parikshit, strategically, yes, but I know there are 2 or 3 important things which we need to be very clear on. If I look at the civil business, for example, road projects, they are very capex intensive, right? So at a given point of time, we need to balance capex and growth. If I look at buildings and factories, they are very specific to country requirements. So we are getting into 4 or 5 countries, but at a given point of time, we can't look at 20, 25 countries. Transmission has an advantage of already having presence in 70 countries, and that's the advantage they are taking. So while we continue to remain bullish on saying that we will grow across all segments and internationally, but is it going to be at the same speed of transmission? May not be, at least for the next 2 years. Over a 4 to 5 years perspective, clearly we'll see all businesses, whether it is oil and gas, whether it is roads, whether it is buildings and factories, whether it is water, urban infra, all doing reasonably well. But the advantage which transmission has of being in 70 countries for the last 10 years is something which will be helping them at least for the next 2 3 years, if not beyond that also.
Okay. So coming to the second question on the margin, so this quarter standalone EBITDA margins have seen some dip. So there was supposed to some synergies coming in with the merger, post the merger between GMC and KPL. So it looks like at least the numbers doesn't look like it's happening. So broadly, if you can quantify why was there this kind of volatility in margins when we're expected to improve performance here on after taking write-offs the last year. So give some sense directionally on the margins, that will be helpful, and reasons for this kind of underperformance during this quarter.
So, I would go back to my, targets at the opening of the year, where we said we'll focus a lot more on PBT at 4.5% to 5%, right? And that's what we have been driving, and that's what we'll be driving for at least the current year and next year. As far as EBITDA margins for Q2, I think it's primarily driven by the mix of order book on a standalone basis. It's not driven by any one-offs in any form. It's just a mix of order book which got delivered, and that's why we were at a margin what was reported. If you look at it on a half-yearly basis, you look at our EBITDA margins, they are at a healthy on a standalone basis at 8.3%. And if you look at a PBT margin also, we are very close to what we have projected. So there's not been any one-offs in the Q2. It's just a mix of order books, and it's just the closure of legacy orders which are happening. So a lot of legacy orders got closed in the previous year. A lot of them, I would say 80% plus. There are few still happening, primarily in railway sector and primarily in in building and factories, some old projects. And there's some hit coming because of that. So on an annualized basis, we continue to be guiding ourselves at that 4.5% to 5% PBT. 5 looks difficult, but definitely at a 4.5 plus levels. With the revenue growth, which will be minimum 25%. I know we are targeted closer to 30 at the beginning of the year, but we believe now 25% is achievable looking at what happened in the first 6 months.
This is the last question on 2 segments, specifically building and factories. So I just wanted a strategy. I mean, here we are very prominently strong in certain markets. So what will be the go-to-market for other geographies within India and Western, Northern and Eastern markets? And on the T&D side, you have given a very strong pipeline of 50,000 crores of. So if you can quantify how much do you think realistically can happen by March, and how much of this will overflow, and how does the pipeline look for FY25?
So I think on the building and factories, our strategy always has been to work with selective players in the country. And even today, if you look at our 10,000 crores of order book, 80% would be with 6 or 7 large players with whom we have a relationship which is beyond the last 15, 20 years. We continue to remain strong in the southern market, but we are building and ramping our capabilities big time on western, eastern and northern market also, with a huge order book which is visible now. So strategy building and factories is work with selective players, look at getting into newer areas, whether it is data centers, whether it is hospitals, or industrial opportunities, and be cautious on the capex driven businesses, because some of the building and factories opportunities are very capex intensive. As far as T&D is concerned, yes, we've seen good bullishness in the overall environment, and we believe that the margin should improve in that business, primarily on the domestic order book, and having an order book of 6,000 to 7,000 crores visibility in the next 1 year on our domestic would not be a challenge. But while we say so, historically 15, whenever there's a tender-driven process, unnecessary competition comes in, and we want to be beware of that. But we will not be building that order book by compromising on profitability in any form.
But is there any issue with the supply chain in the T&D segment? Because kind of ordering which we are seeing now, even other peers are highlighting that there could be delivery lead times increasing for transformers, substations, and other high voltage equipment. So, and even the pricing going up there. So, are you seeing any signs of that happening with serious price hikes being taken, and that could impact our margin or the delivery timelines being extended?
So we are seeing some impact of this on the substation business within transmission and substation. If I divide this, so on the substation business, definitely we are seeing some impact of it, which is delaying a few projects. It might not have a big impact on margins because we had already inbuilt that. On the transmission side, as far as supply chain is concerned, we're not seeing much issues as of now, but we want to be cautious about it given the geopolitical situation. Where if again freight issues come up, that's something which we need to be worried about. But as of today, in the core transmission business, we do not see much issues. But on the substation side, we definitely see some issues on supply chain.
Okay, sir. Thank you, and wish you all the best. Happy Diwali to you.
Thank you, Puneet.
Thank you. The next question is from the line of Renu Baid from IIFL Securities. Please go ahead.
Yeah, hi. Good morning, sir.
Morning,
so my first question is on the revenue side, on the guidance which you are now indicating 25% growth versus 30% growth earlier. While first half growth has been in mid-teen level, what are your concerns where you think growth may be softer than expected in the second half? Is it primarily election-led, or it is more constraints on the customer end or some geopolitical issues, especially Israel, Middle East, where you think there could be some softness?
So, good morning. I don't think either of the two are reasons why we have reduced our projections. It's neither the political, neither geopolitical issues. I think it's come down primarily because of delay in some orders which we're expecting, and we're getting out of our Australia order where we were L1, where we had projected some revenue to come by the year end. So it's primarily driven by these two factors. We remain very confident of achieving what we have projected now. So it's not got, and there could be some very small impact of supply chain on the substation business, but that's not significant enough for that 30 to become 25.
So like more than substation, do you think labor is a bottleneck potentially as we move towards fourth quarter and first quarter of next year?
So, Renu, historically, first quarter of every year, labor always is as a bottleneck given the, the transition which happens on the agriculture side. A lot of people would go back and come back. But next two quarters, we don't see labor to be a challenge on a current order book in any form. Neither labor nor supply chain nor waiting for any new orders. So that's why next two quarters we're pretty confident. And I don't think anything to do with election will have impact on the revenue or the profitability in the current order book.
Sure. The second question is, first half our standalone EBITDA margins have been about 8.3%. Full year level, you're guiding close to 8% levels. Given the fact that some of the bulk of the legacy orders are already behind and just few of them are left, why should margins not be at least 100 to 200 basis points higher than the first half, given operating leverage and execution kicking in?
So, Renu, first, a couple of things. We're not guiding for EBITDA at 8% for the balance 6 months. I don't think we have guided for that. We still say that we're guiding for PBT in the range of 4.5% to 5%, wherein EBITDA could be 8.5% and above. Second, we still have some legacy projects which are getting completed. And also, parallelly, we are ramping up our abilities in the urban infra and B&F beyond South, right, which could not be as high margins as our normal businesses. Because that ramping up is equally important, looking at the opportunity from a 3 to 5 year perspective. So given that, I think we're pretty confident, and if you look at, the standalone half one PBT margin also, at 4.5%, we're pretty confident we will be in that 4.5% to 5% from a PBT level.
And next year, the margin should see some material improvement given legacy projects will be behind in FY24.
So I don't know the definition of material, but they should definitely show some improvement, right? And I'll be happy to provide the data maybe in March or maybe January or March. But definitely there should be some improvement unless something else comes up. But on the current order book, with the current situation, I definitely see some improvement coming into the next year.
Got it. And lastly, on the monetization or exit from non-core businesses, while you have mentioned in opening remarks a few things in WIP, just some update, how much more time to exit from Indore real estate project? It's been lingering around for quite a long while now. And any timelines that you would like to give in terms of targets to move out of the road boat assets?
So, on Indore, we stay committed to our earlier target that by December 24, we'll be out of that project. In the current year also, we have seen 25 odd crores of cash flows coming in and sales of 40 plus crores happening in the first 6 months. So, Indore, we are pretty confident by December 24, latest, we'll be out of that project in every form. As far as road boot assets are concerned, our advisors continue to work on looking at opportunities beyond the one which we signed last time. We should be looking at signing or exploring a non-binding again in the next 2-3 months. And once we do that, we could come back to you with a definite timeline again. The only good part is now the road assets, if you look at it as a bunch of assets, they're all, there's a break even, they're getting into the cash positive zone. We don't need to fund anything for their own assets, it's only for debt repayment. And at least we're not desperate enough to say that, they're taking cash or profit in any form as far as the assets are concerned. It does not mean that they're declared as core, they still are non-core, and we are looking at exiting it. But the stress is much lower on the assets as compared to what it was in the previous few years.
Got it. Thanks much and all the best, sir.
Thank you.
Thank you. The next question is from the line of Amit Anwani from Prabhudas Lilladher. Please go ahead.
Hi, so thanks for taking my question. Just wanted to understand on the margin front. You did highlighted that there would be a margin ramp up in few of the segments where we are, including BNF and few other segments. Just wanted to understand how the margin profile is across international T&D, domestic T&D, BNF water, and where we are expecting a major margin improvements in 12-18 months in each of the segment, if you can highlight on that.
No, I think happy to give you details, whatever we can provide, but I just want to clarify, we've not spoken about margin ramping up in the current next 2 quarters. We just said that we would be in what we have projected at the beginning of the year, 4.5 to 5 levels. Next year, there could be a ramp up, but we will come back with those numbers by the end of the year or early next year. As far as business segments are concerned, T&D as a whole continues to be at EBITDA, which is in the range of 9 to 10%. Our building and factories business has been doing EBITDA, which is more in the range of 10 to 12%, depending on project to project. Oil and gas and railways have been in that oil and gas, railways and transmission domestic has been in the low single digit, in the range of 4 to 6%, depending on project to project. And some of our new businesses which we're getting in, whether it is urban infra or B&F beyond south, have also been in the range of 6 to 8%, which is very different for every project. So the new businesses are not going to help us immediately to ramp up businesses, ramp up margin, but the new businesses would balance the margin, coming from some of the established businesses, because we are ramping up that business which requires additional cost at this stage.
All right. So my next question is on the Sri Shubham Logistics. How was the utilization losses? Any update? And second part is on investment in road boot asset. You did mention some amount you did this quarter, and basically for debt repayment. How much more will come for debt repayment here? So these 2 parts.
So on the Shubham business, we've not seen a big ramp up happening. So our revenues were very similar to what they were in the previous year. Q2 revenues of around 28 crores with a negative PBT. So we continue to remain cautious on that business, and currently with a huge difference in the minimum support price provided by the government and the retail price, we're not seeing huge inflows coming into the agri warehouses across all our competitors, including ourselves. So currently our strategy is very simple, that whatever within Shubham is non-core to us, some land parcels, some warehouses where we believe we do not see huge opportunity, we're exiting those. and parallelly making sure that at least the debt reduces on that business over a period of time. And that's a key focus as far as Shubham is concerned. SPT, you want to just add on the road assets, what we expect in the next 6 months?
So, good morning. On road assets, H2, normally there will be a better traffic growth and we can see the better revenue. Assets, they are break even now, as Manish said, on the PBT level. As far as but these road assets, they are in their last leg of the debt repayment as well as the maintenance cycle. So they will require some amount of infusion going forward for these two items. And as far as the sale is concerned, yes, we will continue to look for the right value at the right time. We will diversify them or divest them. In fact, we are not in hurry, as Manish said, because we are already break even. We will look for the right opportunity to divest. That is currently on the position on the road.
And we believe that we have infused around 45 crores in the first 6 months. We might have to infuse similar amount of 45 to 50 crores in the balance 6 months, primarily to repay debt.
Sure, sir. Last part on the merger synergies, we did highlight it in earlier calls that there could be some 100 crore interest cost synergies, and we can see, I think this quarter we are at about 3.3%. So would you like to give any status on how the merger synergies are panning, and have you lowered your expectations or it is going on track?
I think as far as merger synergies are concerned, we believe we have done better than what we had projected. It's the way if you look at it. So interest rates have gone up by closer to 200 basis points in the last 1 year from the time we declared synergy till now. If you look at the combined entity, the rating is for the erstwhile JMC is 2 notches higher with a similar rating to what KPTL has. And the combined rating of KPIL at AA is a rating whereby interest cost of the erstwhile business has reduced significantly. If you look at the interest cost increase also in absolute numbers, it's much lower than the increase on even as a percentage on our revenue. So on an overall basis, there are 3 areas where we have already achieved reasonable success. One is interest cost. Second is our ability to bid for large projects, and you've seen one large data center which we won. We're bidding for a few large international projects also. You'll hear about that soon. Also on manpower rationalization, we have made sure that whatever additional people we had out of the merger have been deployed into new businesses wherever they were fitting in, because there's so much growth coming in. So on an overall basis, while numbers you might not see exact that reduction of 100 crores, but if you give that impact of 200 basis point increase in interest rate, you see that we have already achieved that reduction.
And that reduction is also absorbed by the growth, in fact.
Yeah, it's visible.
Thanks for taking my questions. All the best.
Thank you. Ladies and gentlemen, anyone who wishes to ask questions, and please press star and 1 at this point of time. The next question is from the line of Ruchita Kadige from iWealth Management LLP. Please go ahead.
Hello, sir. Good morning and congratulations on a recent set of numbers. My question was on the consolidated book. So the guidance that you gave on the sales side was on the standalone book, right? So on the consolidated, what is the kind of growth that we expect, and on the PBT margin, if you can give some clarity on that.
Sure. So I think on revenue, even at a console level, we believe we will grow at 25% plus for the entire year. We've seen for the first 6 months growth of around 17%, but we are pretty confident that we should be at 25% plus growth on revenue on a console basis. As far as PBT margins on console, we believe we should be in the range of 4 to 4.5%, more towards 4%, with an EBITDA which is in the range of 8.5 to 9%. We had an exceptional cost coming in Q2 on a bank guarantee encashment in one of our subsidiaries, which we are fighting for, but as per accounting policies, we have taken that entire hit of around 15 crores. Otherwise, you would have seen that margins coming in H124 also. So we're guiding for that 25% plus growth and margins in the range of 4 to 4.5% on a console basis. PBT margin.
Understood, sir. And I had another question on your urban infra, railway and water order book. So this quarter around, there was no substantial order book that we received. Like it was around 100 crores or. So how do we see this going ahead? Like how is the pipeline and how do we see this coming?
So I'll just divide this into three different segments. As far as railway business is concerned, as I said earlier, we are slightly optimistic, cautious on this because of a huge competition coming in and because pricing levels are not something which have margins inbuilt. So we have a reasonable order book of around 4,000 crores in railways, which gives us visibility for next 2 years. So we are cautious as far as railways business is concerned. As far as water business is concerned, I think we've got good orders in Q1, and we've also declared some orders yesterday in our order, and we're pretty confident of receiving orders in the range of 4,000 crores for the current year. We're also L1 in good orders in water business. As far as urban infra business is concerned, we're ramping up that business, and we are very happy to have our first success in underground tunneling in a metro project, where we are L1 in one large project. And that order we're expecting should be coming in anytime in the next few weeks. So that's a business which is very capex intensive. So we are not running into that business like, let's say, growing at, let's say, 20, 30, 40%. Because it's a very capex intensive business, we're looking at project after project. And the plan is over the next 2 years, ramp it up to a level that it becomes similar to a T&D, water or B&F. So we are growing it, we are very focused, but we are cautious on that also.
So, sir, this 25% sales growth that we are speaking about, so the major execution we are expecting in which segment?
T&D, B&F and water. If you look at today our order book, closer to 78% of our order book is out of these three segments.
Right.
So we expect all three of them to be doing 25 to 30, if not water is doing closer to 50%. Right. So these three businesses will drive primary revenue growth both in the current year and next year.
Okay, sir. Okay. And next year, sir, you were providing the guidance of around 25,000 crore on sales. So are we still guiding for that, or is there any change?
Well, I think we're pretty confident of our vision for 2025 on all parameters, which includes revenue, profitability, order book, as well as improvement in ROCE. We're working towards it, and as of today, the team and the senior management is pretty confident of achieving our vision 25.
And so, just last question, what would be the risk to these guidance, like on the margin front and on the sales front, if you could just try to help me with that, like one or two major risks to it?
I think the biggest risk today is the geopolitical issues and the impact of that on supply chain or on, let's say, anything to do with lines of credit available from funding agencies. So biggest risk, if you ask me today, the first one is a geopolitical issue. The second one linked to the geopolitical issue is the volatility in commodities and forex, if at all that comes up. And the third, which is, scarcity of resources. While we have ramped up enough to be looking at growth in the current year and next year, but availability of resources is also a key challenge, whether I look at labor, whether I look at professional resources, whether I look at, banking resources, everything. So to me, 1, 2, 3, this three would be the biggest risk. While we say so, where we are today, we've inbuilt those risks into some of our numbers, and we're pretty confident unless there's something very exceptional, we still will be achieving our target.
Okay, sir. Thank you so much.
Thank you. The next question is from the line of Deepak Narnolia from Birla Sun Life Insurance. Please go ahead.
Hello. Yeah, good morning. Am I audible?
Yes.
Yeah, sir, correct me if I'm wrong, but consolidated revenue, you are saying 25% growth for a year. So initially you had guided for 30% growth, correct?
Yes, you're right. We revised the guidelines from 30% to 25%.
Achha. And still, for the first half, the growth is somewhere around, I think, 16-17% types growth. So second half would be better than the first half. That's what you are saying, even if we factor in 25% growth.
Yes, for sure. We are targeting second half growth of closer to 30%, if not higher than 30%. And that would give us a console growth of 25%. Typically, second half growth is always much higher than the first half growth, given the nature of our business.
Yeah, but most of the companies are talking about elections in the year and a weaker second half.
No, I don't think in our order book we will have any significant impact coming because of elections. And I would like to highlight this properly to you. I would like to go on our top 3 segments. If I look at transmission international, it has no impact of elections. If you look at transmission domestic, primarily order book is with Power Grid, which it would have no impact of elections. Power Grid and a few private sector developers, which would not have any impact. If you look at buildings and factories, 85% of our order book is with private sector, right, which has no impact of elections. If you look at water business, it's primarily driven by the Jal Jeevan scheme, where, funding as well as the push by everyone. Actually, the push would be 2x because of elections. It will not reduce focus, it will only increase our revenue. Because given elections, there's huge pressure on delivery on all water projects. So, in our order book today, we do not see any impact coming because of elections, at least in the next 2 quarters. What happens in Q1, Q2 of next year is something which we will review again in February, March, but pretty confident next 2 quarters you will not see any impact coming.
But as far as the moderation is in sales guidance is concerned for the year, so what has gone wrong in comparison to your initial expectation?
So 2 important things. One, we were L1 in a large project which we have exited. Australia project which we were declared L1 and which we have exited. That has had some impact on revenue. Second, a couple of large projects in urban infra and oil and gas, which we have been focused on, got delayed. We were expecting those projects to come in May, June, but they are now just coming in now in October, November. So given the delay in those new projects and given the exit on the Australia project, we believe, and also something to do with supply chain issues on some of the substation projects, we believe that we might not be able to achieve our targeted 30%. But we will achieve 25% without compromising on profitability and balance sheet ratios.
So one last thing, do you see any risk to this 25% guidance again? Because initially you had guided for 30% and now it is being cut down because of certain projects. So now do you see any emerging risk in this 25% guidance also?
I don't think so, because today we have full visibility on the order book which we need to deliver in the next 6 months. We have also inbuilt issues if at all they come on supply chain or the substation business. Unless there's huge geopolitical issues, which all of us will know together, right? It's not that I would find out and you would not. Unless there are huge geopolitical issues or freight issues in terms of non-availability of ships and all of that, I don't see a challenge in achieving this 25%.
Okay, sir. Thank you.
Thank you. The next question is from the line of Bharat Sheth from Quest Invest. Please go ahead.
Hi, good morning, Manishji.
Good morning, Bharat.
Sir, on domestic T&D, I believe that opportunity looks, tendering around 50 to 70,000 crore kind of a thing. And I believe it's largely on our renewable side.
So, Bharat, opportunities coming across the country, yes, a lot more to be added as capacity for the renewable segment generation, primarily in Rajasthan, Gujarat, but we're seeing opportunity across the country. So we're seeing some traction coming up in let's say, the Leh Ladakh side also, where recently the government has approved that large project for Power Grid. We're also seeing some traction coming in South India, but yes, you're right, 60 to 70% of new order books are more in Rajasthan and Gujarat to take care of the renewable capacity which is being added in the country.
So, 2 things are on that side. So, I believe that timeline for completion is relatively lower because of, they come up very fast vis-a-vis thermal power plant. And second thing, there are a lot of issue related to power fluctuations. So, SETCOM opportunity, which was early in between, has, this gone down. So how do we see the SETCOM opportunity in this whole segment and the timeline?
No, so you're right, Bharat Bhai. The timelines now for majority of the projects which are getting floated is more in the range of 24 months. Rarely we're getting projects which are more than 24 months. So 18 to 24 months is the timeline for majority of the new projects which are being awarded now. As far as SETCOM opportunities, I think, I still believe that those opportunities will come back because that's something which we will require as a country over a period of time. Maybe not in the short course of time, maybe not in the next 6 to 9 months, but beyond that, again, I believe that those opportunities should come back for everyone.
So how we have built our capability? Earlier we were going along with the JV partner, and so now can we manage our own or?
So today on the substation side, we built huge capabilities over the last 5 years. Today, I think we qualify on 95% of the tenders which get floated, bearing a few high-end GIS tenders which we still don't qualify, but maybe in the next 6 months we'll qualify for that also. So today, I think we are doing every kind of substation projects, domestic and international, right from a 230 to 400 to 765 kV. We are doing both AIS and GIS projects, and as I said earlier, more than 95% projects we qualify by ourselves. And the target is even for that balance 5% in the next 6 to 12 months, we will have all qualifications.
And which are others, sir? I missed, in between. So what are other opportunity are we seeing in domestic as well as in T&D side?
So as far as domestic is concerned, we are building our urban infra order book with selective orders. We took order on the metro last year. We've now taken underground metro tunneling where we are L1. We should be getting that order. We are ramping up our capabilities in B&F in north and west. We are ramping up our capabilities on the international front, both in all three segments, which is oil and gas, B&F, as well as roads. So on the domestic front, I think we are bullish on all three business, T&D, water, and B&F. We are cautious on railways and oil and gas in the domestic front as of now. Internationally, I think there are huge opportunities. We're just making sure that we take those opportunities which our balance sheet can sustain and which we can deliver in the defined timeline. Sorry, Bharat, is that clear?
Sorry, sir. Mr. Bharat has left the question queue. So
okay.
We would take the next question from the line of Ashwani Sharma, from ICICI Securities. Please go ahead, sir.
Yeah, good morning. Thanks for the opportunity. First question is on the working capital. We have very well managed our working capital days at around 104. Just trying to understand, what is helping us, because when we look at your closest competitors of working capital cycles around, it's pretty much higher compared to yours. So what is helping us and what is our strategy going ahead? And the related question is, how do you see your debt by end of FY24?
One key reason which is helping us on working capital has been our relentless focus on closure of projects. I think that's something which is a lot more driven in the Kalpataru environment, where without closure of projects, the majority of the senior management CRAs have a huge weightage for closure of projects, and that's really which helps us on differentiating ourselves from anyone else. One. Second, I think we've also been cautious on not getting into projects which have high retention or low advance. So there are a lot of projects in Middle East where retention is as high as 20%, and we've been very cautious in not building that order book, because that is an order book which, while there could be a margin, but it has a challenge on the balance sheet, and while we have opportunities everywhere else, we're not getting too much focused on that. So our second advantage has been not getting into projects which are very bad on payment cycle. And third, I think from a long-term focus, I think debt has always been a big focus for our group. And if you look at it the last 10 years, debt is now a number which we have always kept under control without compromising on vendor payment days. So if you look at our vendor cycle also, we are the lowest in the industry, and on working capital also we are the lowest in the industry. So focus of right book and relentless focus on closure of projects. These are the two things which are helping us.
So is it possible to give, segment-wise breakers of the working capital? I mean, T&D, water, BNF.
I might not have the data with me readily available, but if you need that data, you could connect with Kunal or our finance team later on to take that data. But I know one thing, that our international business is much lower on working capital days, and some of the businesses are even at the range of 30, 40, 50 days. And the domestic businesses, typically private sector is more in the range of 90 to 100 days, but the public sector, which is SEBs or PSUs, all of that is more in the range of 120 plus days. If you need specific, it might just help for you to connect with either our IR or finance team, and they'll be able to help you on that.
Sure, sir. Second, and just a bookkeeping question. So, Australian order that we had got, you have lowered your revenue estimates. What would be the impact on our order inflow during the quarter, because we have not cut our order inflow estimate?
No, so, we still believe on an overall order inflow, we will be there at 25,000 crores, because while the Australia order book has gone out, we are seeing huge traction coming in domestic T&D, and we are also seeing some traction which was beyond what we had thought of coming on the international business in some other segments. So even with the Australia order going out, which our share was a reasonably good number, we believe that on an overall basis, we will be able to reach our targeted 25,000 crores. If you look at it today, we have visibility of 17,000 crores already, including L1. We have declared 12,200 and we are L1 in 4,300. So with that, I don't see a challenge in achieving a 25,000 crores order inflow target for the current year.
Thanks, sir. Those were my questions. Best wishes.
Thank you.
Thank you.
The next question is from the line of Abhineet Anand from 3P Investments. Please go ahead.
Yes, sir. First of all, if you can, I think I missed your margin for the segments. You did mention about some of the segments which will be below the company average, like oil and gas. If you can just, let me know. Oil and gas, you had referred to 4 to 6%, right?
Yeah, so you're right. Oil and gas.
Other sectors, if you can just let us know.
I'm sorry, just give me a minute. No, I think the margins, what we had guided earlier, we continue to be at similar levels, with transmission being in the range of 9 to 11 and building and factories being in the range of 10 to 12%, and water being in the range of, again, 8 to 11% project to project. Our margins are lower on our oil and gas, railway, and urban infra business. Two of them given the competitive intensity, and one of them given that we are ramping up the business right now. So it requires some additional capital, some strategic bidding, some selective ways of winning projects. So three businesses, which are our core businesses, will be in the range of 8 to 11, and the three businesses which are also core but not doing so well today would be in the range of 4 to 6%.
Okay. And in terms of the PBT margin, we are saying 4.5% is the likely number, right?
Yeah, in the range of 4.5%.
And just on the supply chain, you did mention some issues around substation. That is in particular to India or across the geography, sir?
I think it's across the globe, primarily an availability of transformers and a few related items. It's just an issue across the globe.
And just for the JMC part, our road BOTs, what would be the debt at presently?
Is in the range of about 536, 540.
And this around 80-90 crore that we will be paying will be the debt repayment only, right? For F24?
Yeah.
Thank you for my questions.
Thank you. The next question is from the line of Ashish Shah from JM Financial. Please go ahead.
Yeah, good morning and thank you for the opportunity. So the first question is on the loans given to the subsidiaries and various entities. So what we see in the financials is a net number of 136 crore being given in the first half. You did mention that about 45-50 crores would have gone to the roads SPVs. Where would have been the balance amount gone?
So there's an amount of around 60 plus crores which has gone to Chile, which is normally a project, but it comes in the part of subsidiary because we're doing a project in Chile, but it's via subsidiary route. So it's normal project. We've got the advance last year already out of it. So now is the time when the money is being given. So there is Chile, there is some amount given to Brazil, and there is some amount given to the road assets. Significant number is Chile, which is closer to 75 crores. Sorry, thanks for correcting. 75 crores, which is normal business. It will come back. It is an EPC project, but done via subsidiary route.
Got that, sir. Secondly, on the domestic T&D opportunity, so there are numbers of as high as maybe 50-70,000 crore of pipeline. But how much of this you think is at an advanced stage, which can actually get tendered and ordered before, let's say, the end of this financial year, keeping in mind that maybe Feb and March could be a little slower?
So I believe that significant portion of this, because this number of 50 to 70,000 crores is coming primarily out of all the tenders which are available in the REC PFC websites and some projects of Power Grid. So I believe a significant portion of this should get at least tendered before the year end. Some of that might get awarded next year. But my own assessment is that maybe 75 to 80% of this would get tendered before March 24.
Sure. So, would you kind of put a number of more than 50% to this? Do you think there's a 50% chance?
Definitely more than 50% should get tendered before March 24, if not more than that.
Right. Sir, on the underground metro project that we won, so in our scope, are we actually, going to do the tunneling part? What's our value in the project, and what's the kind of capex that we might need for that project?
So yes, tunneling would be a part of our scope also, along with our partners. We would also be looking at tunneling on this project. The total capex on this project could be in the range of 80 to 100 crores over a period of next 12 to 18 months. Significant portion should be coming in next year. We don't expect much capex to come by March because the ordering cycle itself is around 5 to 6 months. The biggest capex is on TBM machines, which, even if once we place the order, would be a 6-month lead. So from that perspective, the capex should be coming in 24-25 significantly in the range of 80 to 100 crores.
And so what will be our value of the order? Our share of the order?
I might not be able to share that today because we have not declared the order value and all of that. So once we declare the order value, we'll be able to help you with that, share and all of that, because it's L1. We still are expecting that order in the next few weeks.
Got it. And so lastly, when we look at the capex number, the first half capex number seems to be significantly lower as compared to what we did last year, about 79 odd crores versus maybe 260 crore last year. So do you think the second half capex is going to catch up, or this year it would be relatively lower on capex?
So I think we're going to be catching up on capex in the second half. We believe that our capex for the current year would be in the range of 250 plus crores. It could slightly even go up. A lot of capex is expected to happen in the next 2-3 months on projects which we already won. The orders are all placed, so the material is expected and it will get capitalized once the material comes in. So I think on our capex guidance, we would be definitely at 250 plus crores for the current year, and it will only go up in the next year. It does not look like coming up, which is a good sign because there's so much opportunities and ramping up always helps on capex.
Got it. Thank you for answers.
Thank you.
Thank you. The next question is from the line of Bharat Sheth from Quest Invest. Please go ahead.
Sir, sorry, my line got disconnected. Hello?
Yeah, Bharat, sorry.
Sorry, sir, just understanding, on this T&D side, EPC side, sorry. See, our standalone EBIT is around, then if we try to match with the console number, then the loss is 51 crore. Out of that, 16 crore is fairly understandable of the Brazil. So balance is on what account? Sir, because the amount has gone up substantially.
So I think it is a combination of 5 key things. First one, Brazil, which is around 19-20 crores. Second is reduction on profits of Linje Montage. So if I compare on a YOY basis, which has the impact of 8-9 crores, profitability of Linje Montage was much higher last 2 years, and we're expecting it to reduce in the current year. Third are losses, small losses coming on Shubham. Fourth, some of our Saudi projects also, which comes in Concall numbers because they are done through subsidiary routes, have some small losses. So if you look at it, significant amount is international subsidiaries, which would be in the range of 28 to 30 crores. And then Shubham road assets and, some of our international projects which we are doing via subsidiary routes would be the balance number. When you compare YOY, the impact of reduction in margins at Linje Montage also has a big impact.
And how do we see going ahead?
So the current year, we do not see Linje Montage performance improving or reaching back those levels which we have seen over the last 3 years, and that we were aware of at the beginning of the year itself, because we are not focused on too much growth in that business in the current year. Last 3 years, they have grown up by closer to 100%. So this year, we are building resources, we are ramping up on processes, systems, and revisiting a lot of assumptions for the next 3 years. So on an annualized business, as far as weather is concerned, as I said, we should be at a break-even level on an annualized business, excluding this impact which came in. Linje Montage EBITDA margin would be in the range of 4 to 5%, not 8 to 9% at least for the current year. Right. Shubham Logistics at a PBT level would be negative only. We are expecting it to be break-even. It could be either break-even or just slightly negative. On our international subsidiaries, I think majority of the losses are done. We could maybe have one more quarter of losses, but otherwise that's somewhere where we should improvement. As far as from standalone to Concall, I think going forward we'll only see an improvement. We'll never see a reduction coming out of losses because road assets are now positive. The international subsidiaries are moving towards positive. The international projects which are done through subsidiaries are moving towards positive, so that gap will only reduce going forward.
Okay. Thank you very much, sir, and all the best.
Thank you, brother.
Thank you. We would take that as our last question. I would now like to hand the conference over to Ms. Bhumika Nair for closing comments.
Yeah, I would just like to thank the management for giving us an opportunity to host the call, and all the participants for being there and asking all the questions. Thank you very much, sir, and wishing you all the very best and a happy Diwali, sir.
Thank you very much, Bhumika, and wishing all of you and family a very happy Diwali.
Thank you. On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.